Unlocking the power of your balance sheet to grow and protect wealth in volatile times.
Hey, everybody, Russell Gray, co-host of the Real Estate Guys radio show, here with a special edition in our strategy series. And what we're talking about today is, what do you do when interest rates are rising? Investors out there are probably, all aware that interest rates have been rising. Mortgage rates have been rising. In fact, they've been going up quite a bit pretty fast. And that hasn't really happened in a long, long time. So it's a shock for a lot of newer investors. Older investors have developed strategies over the years to deal with that. And of course, I happen to be in that camp. I'm one of the older guys in the industry these days. And so I wanted to go through in real time and talk about how we solve that. So you don't solve it in a bubble. You don't solve it in a little echo chamber. What you do is you get on the horn with people who are in the space, your boots on the ground team, and you muscle through the problem at hand. So I'm doing exactly that today with our special guest. So starting with Stephanie Riley from USA Mortgage Equity Strategy Team. She's a financial strategist, a mortgage strategist. She's been with me. We've been working together for 20 years now, an investor solving these problems every day. So Steph, welcome, and thank you for being here.
Thank you.
And riding shotgun in the mortgage space is Jackelyn Gonzalez from CIVIC Financial Services. She is a niche lender. She deals exclusively with investment properties and investors, small investment properties, and she's used to solving these problems on a daily basis. Her company comes up with creative loan solutions to help people navigate the landscape and make deals pencil. And in this case, we got rising interest rates. And so they've been hard at work. So Jackelyn, thanks for being with us today.
Thank you for having me, Russ.
Awesome. And of course, the other rooster in the hen house here alongside with me is Chris Funk from Southern Impression Homes. Southern Impression Homes and Chris, they're real estate developers. They operate in the Southeast, as you might guess from the name, and they specialize in build-to-rent properties, which is really, really cool. It's been a super hot niche. In fact, we've done a couple of boots on the ground recordings with Chris and his team, specifically to the build-to-rent space. And Chris has a lot of hands-on information, not in just one market, but in multiple markets, major markets and tertiary markets down in the Southwestern United States. So Chris, welcome.
Thank you. Thanks for having me.
So guy and gals, what we're really faced with when we're out there is we are putting properties into contract. We kind of run the numbers based on the financing. If we're doing our homework, we call up our mortgage professionals, say, hey, what's the going rate? And they say, okay, this is it. And you do your numbers. And then all of a sudden they get in contract. And Chris, how long does it take from the time somebody goes into contract until you're actually able to deliver a property?
Really depends on what stage the property is in construction at the time that they contract. Previously, we had been contracting even pre-permit, but with all the construction delays and supply shortages, we've really started contracting after a slab is in the ground at this point in time. In which case, you can expect about a 6-month time period to get from contract to completion.
Okay, so it's no surprise that interest rates have changed a lot in this last 6 months. We don't know if that is kind of a bell curve and it's going to taper off. We don't know if the Fed is going to backtrack and go, oops, didn't mean to crush the economy. We're going to lower them back again, or maybe they're going to continue to go up. And so in various scenarios, you're going to have to make adjustments and you're going to have to make business decisions. We're not here to tell you what to do. We're here to help you understand ways to solve the problem, and you do it as a team. So, there's the obvious thing is you want to try to get the best rate you can. I think, you want to have a good credit profile. You want to make sure that you have approached your mortgage people well in advance of applying for the loan so they can help make sure your profile, your balance sheet, your financials, your debt to income ratios, your credit score, all those things look the way they need to look. And you have time to make some adjustments before, the application goes in. And of course, with a 6-month time horizon, you have time to do that. Another advantage, you get to lock in the price today, right? There's no secret, real estate has been going up, Chris, and you can lock in the price today, and 6 months from now, you might even have some built-in equity based on the market prices. Are your buyers seeing that right now?
Significant equity. Anybody that contracted any time in the past is really almost at day one stepping into equity because the prices have been going up so fast.
Probably the reason why you put them into contract a little bit later, right? You guys capture a little bit of that and you don't take as much risk with build costs and labor costs and stuff like that, I'm guessing.
Well, we love to see our clients pick up that equity, and really for us, it's being able to lock that build cost in. It's still, we can't even lock it at that time, in the true sense of a lock. But you're right. We're trying to control that a little more closely.
Right. Of course, you have those clauses because if things are completely out of your control, lumber goes up 500% again, you're probably going to have to make an adjustment for that. And again, you can compensate for that with making adjustments on financing. So whether the price changes a little bit, the loan size changes a little bit, the interest rate changes a little bit, all of that impact the bottom line cash flow. That's what an investor is struggling with. And so this is really about solving the cash flow, either a thin or even negative cash flow situation, and trying to get to a place where you've got a financing structure in place to control a property for a decade. History says if you buy a property, even if you accidentally buy at the top of a market, and nobody knows when the top is, nobody knows when the bottom is. There's people sitting on the sideline right now thinking, okay, the real estate crash is right around the corner and I'm going to buy properties for pennies on the dollar. I remember feeling that way and then having 2, 3, 4 years of great equity growth go on, and you miss it because you didn't buy. Of course, but even if you buy all the way at the top, at least based on the worst real estate crash we've ever seen, in modern history, which was 2008, 10 years later in almost every market, you were back kind of on track. So if you're thinking 3 to 5 years and you buy at the very top of the market and your financing structure will only allow you to safely handle it for 3 to 5 years, that's a problem, could be a problem. But if you can go 10 full years, if you have a 10-year time horizon, I think my experience has shown that you're typically going to be pretty good. So the key is cash flow. You may not get rich on the cash flow, but if you can control the property for 10 years, you can stay in the game until equity happens. And history says the way the system works, equity is pretty much always going to happen in real estate because they're constantly printing money and they don't have a way out of that trap. And that's a whole different discussion we could have. So Chris, when you offer people a property and you're going through, because you're dealing with build to rent and those are investors, you actually have a pretty elaborate spreadsheet you show them that kind of illustrates. Can either you or Stephanie put that up on the screen real quick so people get a feel for what they're seeing? Because this is really where the problem shows up.
Yeah. So Stephanie,
and show us one where we've got a little bit of thin or negative cash flow.
Sure. I sent one to Stephanie that she's going to pull up here shortly.
Okay.
This sheet we use, for our clients and for ourselves internally. We developed this, we started out as real estate investors only. And so, we weren't always selling our product and, building for other folks. That came later. So this is something that we designed to really track our investments and to determine whether we were making good choices or not. So Stephanie's got it up on the screen here.
Yeah. Okay. So in this case, we got a $500 and basically $10,000 property, and you've got a financial structure where there's a fairly modest down payment. Oh no, it's what, a 20%?
25%.
25% down payment. Okay. 75% LTV. So good leverage, 4-to-1. You got property taxes, insurance management. You got all the basics so that you haven't left anything out. That's good. And you get down to that NOI. The NOI is okay. And then we get to the cash flow on line 36, little thin.
Yeah.
Okay. And do you show what the cash on cash calculation is for that?
Yeah. If you look over to the right in row 27, so we show two cash on cash. It's going to be J27 there. We show cash on cash return, which is slightly less than 1%. Then we show a cash on cash return with tax savings. And that's after you account for the depreciation aspect of the project.
Gotcha.
Which is about 4.8%.
Okay. So in this case, someone who is maybe a little bit inexperienced or looking at something on a very, surface level is going to say, well, 0.8%, why would I make a 0.8% investment? And of course, the internal rate of return or the total rate of return encompasses the cash on cash, the amortization, which is the pay down on the loan, the appreciation on the property over a long-term period of time, and the tax breaks that you receive. Those are kind of the four basic components to affect cash flow, to affect the balance sheet. When you put all that in a blender, you're estimating, and what's your estimated inflation rate?
So we are looking at a real estate appreciation rate of 7%, which right now in Florida, we're seeing closer to a 20% rate of increase. We don't think it can go like that forever. So we're being a little conservative here and putting 7 on our sheet.
Okay, so it's 7 based on the rule of 72. Any asset appreciating at 7.2% a year is going to double every 10 years. And so, what you're basically saying is 10 years from now, this is going to be $1 million property. Now, there might be some ups and downs along the way, but if the overall average of 7% holds, and in residential real estate, the overall average in the United States has been, I think, between 6 and 7 pretty consistently, even when you factor in the downturn in 2008. So this is a nice appreciation, and but not pie in the sky.
And it's in talking to a lot of investors, if I can just mention, because when you look at a cash on cash return and you say, 0.8% or whatever, and they're comparing markets, right? And they're saying, well, gosh, is there somewhere else that I could get a better cash on cash return? And I think, Chris, that's one thing that is really important to talk about in your market is this appreciation or hedge against depreciation, even, because when you're looking at a cash on cash return and you can make the mistake of thinking you're comparing apples to apples, comparing one pro forma to another pro forma, but it makes a big difference which market that property.
Well, and market is not just geography. I mean, market is also product niche or even property type. So if you go in and you get an A-class building, a brand new, beautiful building, you're going to have, that cash flow is really thin. So you go into the hood and you buy yourself a C- or a D property and go, the cash flow looks really great on paper, but your vacancy, your turnover, your damage, I think most people who are experienced understand those things all look great on paper. And in the real world, they're actually harder to cash flow unless you're really, really good at dealing in those types of properties than a nicer property. And so market isn't just geography. Of course, when we talk about geographic markets, what we're considering is we'll come back to this in a minute. So, well, that's okay. It's okay. So what we're considering is the supply and demand dynamic. And the supply and demand dynamic is both on what's going on internally in the market in terms of the what's being built versus to the local demand, and then also the investor demand coming in from around the country, and then also the net immigration or net out migration depending on the property. In this case, we're talking about a Florida property, and I think it's no secret Florida has been attracting gobs of people, especially over the last few years, because the move towards work from anywhere. You get people in the Pacific in the Northeast, in the cold weather, are very expensive, that realize, hey, I can go live in Florida, have no state income tax, I can have a lot better quality of life, warm weather, and I can still very effectively do my job remotely. You've got the baby boomers who are retiring in droves. Florida is one of the top retirement destinations from big population bases out there in the East. So you've got a lot of these things going on. And of course you say, well, yeah, but those people aren't going to be renting from me. No, but they're going to be driving up the price of the homes, which makes the people who might have bought those homes not be able to afford them, and now they need a place to live. And so when you have a price point in a marketplace where you've got a lot of population above your price point, then you've got people, if in the event that inflation continues and food and energy goes up, you've got people who are no longer can afford to live above you, and they start to come down and put pressure. Meanwhile, you got people coming in looking for work, and you have to look at the kind of jobs being created. If they're working class service work, hospitality type work, light manufacturing work, that types of things, then you're going to end up or distribution, you're going to end up having a lot of renting type class people come in. And so market dynamics are a great consideration. So, because if you're not committed to be in the market for 10 years and you're buying in really, really thin cash flow, I would say you're treading on thin ice. Now, I'm not saying don't do it, but I'm saying you're treading on thin ice. But if you like the market and where you think the market's going to be 10 years from now, then to me, it's worth stretching a little bit and trying to figure out how do we get in and how do we secure this thing? I'm not going to get rich at 0.8% cash on cash at the inception. But over time, if the market is strong, rents may work for me. Appreciation will work for me. I'll get the benefit of appreciation and amortization if I use an amortized loan. And we'll talk about that in a minute. And 10 years from now, if this thing doubles in price, if I buy two of them, I could sell one and pay the other off. Right.
Yeah. So, you hit on a lot of great points there, Russ. And, one of them is that in-migration that we're seeing in all of our markets in Florida. We have been the beneficiary of all of the COVID exodus from the north and from California. And it really is, it's driving these rents up. We have a weekly leasing meeting. And one of the things that we focus on is any tenants that moved out that had just rented the home a year ago. And we're looking at, on those particular tenants, what was the increase in rent on those properties when we released them. And for the last 6 months, it's operated in a range between 17% and 23%. So we're on average right around 20% rent growth in that time period.
And this is at a time when gas and food are going up. In other words, so the supply demand dynamic is so powerful that it's overwhelming the inflation dynamic. And again, this is where people say, well, how can I mitigate inflation? Well, one of the ways to mitigate inflation is to invest in anything where the supply dynamic is so powerful, it actually outpaces inflation. And this is an example of that. And this is something I think a lot of people miss when they do their analysis. They just, 0.8 cash on cash. That's not very good. And you're missing the big picture. So it's really, really important, to Stephanie's point, that you understand the market and what's going on in the market. And the only way you really know that is by having conversations with your boots on the ground team, which is why we do boots on the ground interviews with Chris from time to time, why we're going to the Jacksonville market for a field trip this summer. It's because we want to go see it with our own eyes. It's one of the more powerful investment markets out there, but the price point still makes a lot of sense, but it is getting thinner.
Yeah. And so, that's really, what's not accounted for in that pro forma is what are the rents going to do, between now and closing. So when we do a pro forma, we look at what do we know that we can get today. That's what we want to focus on, because we don't know how much the growth is going to be. We know that it's been 20%. We also know that that's abnormal. It could go at 20% again for another year, or it could back off to something more rational, a 5-7% increase annually, which was what we used to put in our pro formas 5 years ago. So, it's hard to say where it's going to go, but I can say with almost certainty that it's going to be higher than it is on the day that we contracted from a rental standpoint. Those rent rates just continue to tick up as more and more people come into this market. And quite honestly, as more and more people get priced out of home buying, so with prices having gone up and interest rates having gone up, there's less and less people that are qualifying for these higher priced homes that are coming online in the markets. And honestly, there's still not enough homes coming online in the market. When you look at the permits that are pulled in Duval County right now, we are still 10% below the peak of permits pulled in 2005. So we've had over 20% population growth in that time period, and we're still producing 10% less houses than we did in that time period.
Well, this is a really important point.
Planning to produce, right?
Correct.
Because you also have that other issue constricting supply.
Exactly.
Yeah. So, that's one of the important points to remember is that the whole build to rent model is based on creating product that caters to an underserved demographic. And when you go back and look at 2005 and the run up to the crash in 2008, there were a couple things that were built into that. Number one, it really wasn't a crash of real estate. It was a crash of credit markets. And, that's always a possibility. And with rising interest rates, you could even argue it's a probability, but we also know how the movie ends because there's a desperate reflation. If in fact that happens, and you're going to want to be somebody who is able to hang on. And of course, if that doesn't happen, if they got their lessons and it never happens again, or doesn't happen again as badly, then that's another reason why you don't want to be sitting here going, oh, it's going to crash. It's going to crash. It's going to crash. It's going to crash, and sit out for 10 years. Well, it doubles. Right. That would be a big miss. You can't make any money on a property you don't own. But the other thing is, and this is a really important point when you talk about those permits, Chris, is last time there was tremendous overbuilding. There was a glut of inventory that led up to the 2008. And it was just people buying properties that were sitting unrented, just speculating, okay, I'm going to buy the property. I'm not even going to rent it out. I'll make the mortgage payment and I'll sell a year for now for $100,000 or $200,000 more than I paid for it. And after that is a very speculative activity. But right now, what I hear you saying is the fundamentals, real demand, people signing real leases, real rents going up, and not enough inventory, and new build inventory, despite your best efforts, is still not strong enough to meet the demand. And of course, you've got the macro thing where so many people are flooding into Florida, which makes Florida in particular a market to consider when you're in a market that is hot as it's been. You know, there's no secret real estate's been hot, but the macro commenters that I hang out with all put it in a blender. And the problem is real estate is not a macro asset. It's not a commodity. And so there are individual markets and individual market dynamics and individual niche products that can really make it work. So market is number one, getting the right market. Another thing is team. That's really important too, because biggest expenses are vacancy and turnover. And of course, your product, Chris, which I love, we've done shows on it on the show, not just on you, but other people that do build to rent. We had John Burns come on from John Burns Consulting, and he talks about how build to rent is just such a powerful niche right now. And it appeals. Now, you sell a lot of build to rent. Tell me some of the reasons why people love to buy build to rent. I mean, from a tenant perspective and from an investor perspective.
Well, the biggest reasons, and it's the reasons that I love build to rent. And I used to do REO. I used to buy the foreclosed homes, renovate them, and lease them. And the reason that I love it, and same as our clients, you're designing the home from the beginning with a tenant in mind. So it's purpose built to be a rental home. And that doesn't mean that there's anything negative about it. It means actually quite the opposite. These homes are built with granite countertops, vinyl plank floors, all things that are upgraded features in a traditional retail home builder.
But super durable.
But super durable. Exactly. Yeah. That's exactly it. So when we have a turnover, we're not having to replace carpet or clean carpet. I mean, that's just a dirty word in our office. Carpeting kills the returns of any rental investment. So if you learn nothing else, that is the thing today, everybody. We don't put carpet in anything, because at the end of the day, it's either going to be dirty and have to be replaced, or it's going to be smelly and you're going to have to reduce the rent to get somebody to accept it. And so, so all of our product is built with the tenants in mind. And there's certain things that we don't put in, like we don't put in garbage disposals. We do put in dishwashers. We never get a complaint from a tenant about not having a garbage disposal. And we also never get any maintenance requests about a clogged garbage disposal. So, these are the type of things that we look at when we design these homes, and we build the homes and we design the size of the homes to maximize the rental yield. So, when you go out and just buy a random home on the market, it's not, they're not designing that home to maximize rental yield. They're designing that home to maximize sale price to a retail home buyer. Two totally separate things. Our homes are going to tend to be a little bit smaller in size. So we build homes from 1,300 square foot to 1,900 square foot, because we find after you get to 1,900 square feet that the rental rate that goes along with that does not increase past that.
Right. For example, you don't get extra rent for a 120 square foot bedroom. You can sell a 90 or a 100, but you knock 20 or 30 square feet off at whatever the cost to build is. And all of a sudden, this is a little bit of value engineering. So, and the tenant gets a brand new property, especially the first one to move in. But even if it's after a year or two, it's still not a very old property because it's been built to rent. So they get that kind of pride of ownership, which usually I think longer tenancy, right?
Exactly. And then on top of that, from an ownership perspective, the insurance is lower. The insurance companies love new construction because it's built to current building codes and standards. So, you're going to get the most discounted insurance rates available.
My favorite thing is new plumbing. Because oh man, plumbing's the worst, right? Because everybody assumes it's there. Plumbing and electrical, they all assume it's there. And if you buy an older property, especially plumbing can be in very, very bad shape. You don't get a huge discount for it because it's hard to figure out until it blows up. And then all of a sudden it's very expensive to replace, and you don't really get any extra premium in resale or rent just to have good plumbing. So to me, when you can buy a property, brand new plumbing, brand new electrical, and you don't have to worry about that for a long, long time. These deferred maintenance issues that really eat up the profits when you buy older properties. And I'm not saying you shouldn't buy older properties. You can't make money with older properties, but in a thin cash flow environment, there's a big advantage to buying brand new properties and really not having as much worry about roofs, water, HVAC, water heaters, plumbing, electrical.
Well, you're hitting the, the kind of the overall picture of that, for me anyway, is just consistency of cash flow. You know what you're going to get every month, and you're not getting a huge surprise, around the corner.
And consistency is super important when it's thin. Okay, so we've figured that out. The other part is team, because you can have a great property in a great market, and if you got a lousy team and it sits empty, or you're not screening your tenants properly, or all that. Now, to me, the unsung hero of rental property ownership is a property manager. So Southern Impression Homes builds properties, but the reason you're so clear on what goes on from a property management perspective, you actually manage these properties as well, right? Or one of your divisions does.
Absolutely, yeah. So our company, Suncoast Property Management, manages all the homes that Southern Impression builds. And, we started Suncoast because we couldn't find the right management team to manage our properties. And again, this was back when we were doing the REOs back in 2010. We could not find a team that was really willing to put in the extra effort. Anybody's willing to charge you a fee when the rent comes in on time, and they just they just pass it along to you. But it really comes down to, what your property management fee is really paying for is the times when the rent doesn't just come in, and when there is an issue, and when there's something that needs to be worked out with a tenant. And hopefully that never happens, but there's always something that's going to happen. If your portfolio is big enough, there's going to be something that's going to need to be dealt with. And, there's a right way and a wrong way.
Yeah. So the point here, folks, is that when you're looking at properties, one of the ways you mitigate cash flow problems is if you buy from somebody who has a vested interest in representing the numbers properly, because they got to deliver them. Right. If it's one thing, like what we love about Terry at Mid-South Home Buyers, he rehabs older houses and does a great job with it, but he manages every single one. So if in the sales process he goes, hey, this is what we think the cash flow will be. It's based on real world experience. It's not just a guess. It's not puffed up to make it sound good. So you buy a pig in a poke, and they leave, and you're on your own, and they have to live with it and actually make it happen. You guys are the same way. And so, but whether you do business with these folks or other people, what I'm saying is make sure that you really spend time finding great quality property management, building a great relationship, asking them how you can become their best client so that they love you and they will go the extra mile for you. And that little extra edge, combined with some of the financial strategies we're about to get into. So you pick a great market, you pick a great product and price point, and you pick a great team. So that's step one to making sure that if you're buying near a top of a market, 10 years from now, you're still happy you made the decision. Okay. So now we got the two ladies here who have been waiting patiently for us to get into their part. They're number crunchers like me. And we tantalized everybody with a spreadsheet, but I broke away from that before everybody's eyes glazed over. But really, I say, do the math, and the math will tell you what to do. So once we've decided, Steph, that we've got a property and we're like, okay, we've got a great market. We've got a great property type. We've got a great property niche, maybe a great sub-market, because there's metros and tertiary markets. And we'll talk a little bit about that in a moment. Now it's time, and you got great property management. So now you take all these projections, these numbers, and you throw them into a spreadsheet. So Chris and his team do it for their clients and prospective buyers. But then you have to actually go deliver on that. One of the major components of cash flow, net after tax, net cash flow, you do the net income minus expenses, and you get net operating income, and then you throw the loan in there, which is where you get the benefit of leverage and the magnification of appreciation and cash flow and tax breaks and all that. But you got to make those loans work in the real world. And so just give us a quick, like, nickel tour of the last few months of where rates have been heading, how quick they've been changing, how they've been affected people's ability to lock rates, things like that. What is kind of the general consensus, the mood of the mortgage rate market right now?
Yeah, well, it's no surprise. It's all over the news. The last year we've seen conforming rates rise over 2%. I mean, it's insane, the pace at which these rates are spiking. And one of the challenges that brings head on is if you're buying new construction and you've locked in your purchase price and you've ran your pro forma numbers at today's mortgage rates, but you don't actually take delivery of the home until 6 months later. Well, in that 6-month gap, you may have seen half, 0.75% rise in mortgage rates. And now the pro forma cash flow that you thought you had when you got into contract to what you actually have when you take delivery of the property is looking different. And so as you start to approach that closing date and you start fine tuning your numbers, you kind of, that's where Jackie and I come in and start looking at this and going, well, depending on the overall portfolio of an investor, what are some things we can do to make sure they're still secure in this investment and they're getting the return that they were hoping for? And financing tweaks can really make a big difference in that. As far as, so that's what we've seen historically with mortgage rates. I don't know when this will be released, this recording exactly. So there definitely has been some leveling off as of late. You know, the Feds come out, they're still expected to rise 0.5 point in June, July, and we'll see in September. There's a lot of talk in the industry and macroeconomics and all of that. You know, it's pretty much widespread. Almost every recession indicator you can look at is flashing recession. And so the wild card, of course, is if that does come to be true and the Fed backpedals and we get some interest rate relief down the road. And so one of the things to consider when you're looking at financing in a property is like, well, yes, maybe my cash flow is thin today, but if interest rates reverse course, the financing can be changed. It's not a permanent forever thing. And so if rates were to come back down 2023, 24, 25, you could, replace that financing and immediately improve your cash flow from your starting point. So, it's kind of like, this is almost this feeling of worst case scenarios. Like if you can make the numbers work in a fabulous market, brand new property, and at these rates, you can cash flow, then there's only up to go from here, up in cash flow with rents, inflation hedge for sure, and possibly later on a restructuring of the financing with a big bump in cash flow for that reason. So anyhow, so that's kind of the rates and how they play into what's going on.
Well, we say all the time, you can't make any money on a property you don't own. And so in real estate is a long-term investment and you control it with cash flow. So cash flow is super, super important. And a big component of the cash flow is rents and the mortgage payment. And so we already talked about kind of the rents in the marketplace and all of that. And so, you're looking at the mortgage payments. So we're going to get into some mortgage strategies in a little bit to deal with some of that. In fact, maybe it'd be a good time to just throw the spreadsheet back up. But while you're doing that, one of the things that I just think is important to say is if rates go down, you're going to be happy you bought because you'll be able to refinance. And lower rates would mean probably an acceleration of increasing equity again and rents. And so you're going to be happy that you control it when you did, and you can go back and fix the financing because you already have set your price. If interest rates go up, then you're going to be happy that you locked in today's rates because, in hindsight, you're going to go 6%, 6.5%, even 7%. That's a pretty good rate. I remember, when my first rental property was nearly 13%. So I would have just, had a party if I could have gotten 7%. So it's all relative. So if rates go up, you're going to be happy you locked. If credit markets collapse, taking prices with them temporarily, you're going to be glad that you have debt. Now you're going to wish that you could go buy at the cheaper prices, but if you've used leverage to control the property today and preserve some of your cash, you'll be able to go in and maybe be a cash buyer in properties. Let's just say worst case scenario, one of these houses completely collapsed, so you could buy it for $100,000 for what would have been a down payment. You can go buy the whole property for cash, and then when reflation occurs, as everybody's pumping it back into the market, which we know that's what the powers that be do because that's what they did after 2008, then you can throw new financing on it. So, as long as you can weather a downturn, if it happens, and I'm not saying it will, but if it did, as long as you can weather that downturn by controlling the cash flow, guys like Kenny McElroy had huge portfolios going through 2008. They actually weathered their portfolio that they had purchased in the run up to 2008. They were able to hold on to all of that through the downturn and go on a shopping spree. And of course, today, everything in their portfolio is way, way up. And so that's kind of the formula we're looking at. Now, you may not be a 10,000 door apartment investor like Kenny McElroy, but you can do it with 4 doors at a time, and with 10 Fannie Freddie loans available to you at fourplexes, you're talking 80 rental doors. That's not bad. and through syndication, you could probably build a little portfolio. So getting into this stuff. Okay. So take us through a scenario. Just show us, this is a 30-year fixed. I can
Right.
see
Speaking
there.
Fannie Freddie. If you
Walk
go
us through this
Fannie
and show us a
Freddie-
cash flow, and then let's start solving for making the cash flow better and pull Jackelyn in to do that.
Mhm. So speaking of Fannie Freddie, if we're looking at financing on a property like this at the going rates around 6% for investment property, 75% LTV, fully amortized, after your income, your vacancy, all your expenses, and that debt service, we're looking at cash flow being pretty thin at $100 a month prior to any kind of depreciation.
What if rates go up to 6.5?
So let's look at that. So what if you get in contract rates today are 6%, but you don't get delivery of the product for 6 months? And between now and then, let's just change our interest rate and say that it goes up to 6.5%. Well, now you are negative cash flow.
Okay. For the
And-
price of a pizza. So it's not horrible. What if it went up to 7%?
And
Survey says.
it says,
Okay, now it starts to get a little bit more painful. So let's say this is the scenario, and now we're faced with this. We're like, okay, today's rates are 7%. I pro forma this at 6. It made sense to me then. Now at 7, I'm skittish. I don't know if I should do this or not do it. Meanwhile, Chris would say, yeah, but the property's worth 550. Because in that period of time that interest rates went up, equity happened too. But let's say it's not. Let's say it just is what it is, and we're just trying to solve for the cash flow problem. When you ladies are sitting down with an investor faced with this type of problem, I know, being a strategist myself, there's different things I can pull out of my hat. But what are some of the things you guys talk about? If you can't change the interest rate, what can you change?
if
Well,
we
you
want
could-
to go, go ahead, Jackie.
You could end up just changing the type of mortgage that you get. So what we offer is we focus strictly on investment property financing. And a lot of our investors are opting to go with an interest only option in order to increase their cash flow because it will lower their payment. So I don't know if there's a way to show the interest only piece on here and how that would affect.
Okay, we're going to switch spreadsheets, I think, and try to go that. And again, ladies and gentlemen out there watching, this is exactly what we do. It's like we look at a scenario like, okay, we got to start figuring out how to change our inputs with real world inputs to move the thing around. So now we go interest only and 10 years of interest only.
Hold on, let me
Update the numbers back to 7. Yeah.
well, if we go with a 10-year term, let's say rates are around 6.5% on a scenario like this. But to Jackie's point, she's got an interest only option available.
Right.
And so now with nothing going to principal reduction, that mortgage payment, even at a higher rate than 6%, is lower payment, $2,071. And so you're actually remember at 6% fully amortized, we were only positive $100 a month or something.
It was, yeah, but it was, we were minus 19 at 6.5 before.
And
So-
now we're positive 326
326
a month or $4,000 a year.
So from minus 19 to plus 326, just by using the interest only option, that buys you 10 full years of improved cash flow on a property while you're waiting for rents to come up, you're waiting for interest rates to come down, you're waiting for the market to appreciate. So you have a degree of control. Again, marrying that to being in the right market, having great property management, the right product type, and all of that. So can you do it if we did 7% just to see what that would be? Since we're looking at that minus. Okay, so you're plus 167 from minus 146 or whatever it was before, right? Okay, so that's like a plus 300 spread. So between $2,000 and $4,000, let's say. Okay, so that is one way to do it. I know a lot of people would consider making a bigger down payment. My argument against that bigger down payment would be that two things. One is you put the equity back in the property. And the problem is if the market goes down, you lose your equity. If you want to access your equity, you got to do a cash out refinance. If God forbid you lose the property to foreclosure, you lose the equity So putting a bigger down payment on a property in order to manipulate a rate or cash flow, to me, is typically a bad strategy, although that'll be the first one a lot of people will recommend. There are alternatives to that. So one of my favorite alternatives is you take money that you would have put, say you put extra $100,000 down on the property, just to pick a number. If I put that $100,000 in a high yield note, 8 to 10%, maybe even 12%, now I've got income coming into what is a portfolio strategy where I've married a property to an income producing note. Instead of putting the down payment in the property, I put the down payment into a note, which gives me better cash flow. But more importantly, the value of that extra $100,000 isn't in the property. It's not subject to foreclosure. It's off to the side. And so as it's off to the side, you have the ability to protect it. So we don't have time to crunch those numbers. That's a strategy. Let's get back into the loan strategy, Steph.
So coming back here, so that would be a 10-year term. Another option on term, what Jackie was talking about, is product types. Is Jackie, you have some options within those terms.
Yeah, so there are a couple different ways where we could actually lower the interest rate. And Russ already mentioned one, which is putting a higher down payment. But if that's not what someone would want to do, then the other option is to maybe, instead of going with a 10-1 ARM, we switch the program over to a 5-1 ARM, which gives you 5 years at a fixed interest rate period. And that lowers your rate by 0.5% with us. And so that would also.
So you're trading a little bit. What you're doing is you're taking some risk, because you're saying, hey, I'm betting 5 years from now. And 5 year, just so when people say 5-1 ARM, so people understand, that's 5 years where the interest rate is fixed, and then it adjusts every year thereafter, but there's a cap to how quickly it can go up. So if interest rates went completely out of control, you're not completely at the whims. You can still be under the market, even though if interest rates were way up above whatever your cap was. Is that still true? That's the way that it was back when I played,
that's still
in the mortgage
true.
business. Okay.
Yeah. So we have caps in place, and we can go over the caps as well. I think one of the biggest misconceptions about the ARM products is when someone sees a 5-year interest only period, they think that they actually have a maturity after that 5-year period, and that's not the case.
So it's not a balloon. It's still a 30-year loan. It's just the interest rate that changes.
Exactly.
Yeah. Okay. So 5-year interest only, fixed rate, and then every year adjustable thereafter with a cap. Okay. So that's another strategy. We need to wind this thing down, because I got another meeting to get into here real quick. So I want to hit on a couple of quick things while we can. And that is that for some of you, you may say, hey, I don't have an extra $100,000 to put into a side investment to blend the cash flow on the property. If you could buy 2 or 3 of these properties, so $125,000 down on the property, and say you need to put, I don't know, say you do 2 properties, so it'd be 250 down plus 100 into a high yield investment. Then what the ladies would do is crunch those numbers for you, and they can make introductions to people. In fact, Chris has some products for accredited investors that actually provide yields in the 8% range. There's other people we know that have, between 8 and 12. It just depends. You have to look and understand the collateral and whatnot. But syndication is another way to do this. Syndication is a way that you can raise money to do a portfolio, and you raise all the down payment money you need to buy 4 or 5 or 10 of these properties from Chris, have them all property management, and then buy some notes, high yield notes to put in the portfolio alongside. And then you use these interest only option strategies in order to create the property, the cash flows that you need to be able to hold the property long term. And then all of a sudden, now you've got a portfolio strategy that gives you more secure cash flow. And even a small investor can do it simply by aggregating a few people. So not everybody's in for syndication. I personally love it. I think it's best opportunity in real estate, as most people who follow me know. But because I need to wrap this up, and you guys have been, fantastic. What I want to do is make sure everybody knows how to follow up with you. So there's a couple things. We've got, first of all, I think just understanding the Jacksonville market. We're getting ready to do a Jacksonville field trip. And when we say Jacksonville, there's peripheral markets like Palm Coast, and we even go down to Ocala. There's kind of that upper Florida region, very, very popular market. But you can send an email to Jacksonville field trip at realestateguysradio.com. And we'll put that information down in the show notes below also. And that will give you information about how to contact Chris and his team at Southern Impression Homes. And you can see what they have and how that works. You want to come see the market. Robert and I will both be there, and that'll be a lot of fun depending on when you actually see this recording. Hopefully there's still time for you to get on board. If not, get on the waiting list for the next one. Stephanie Riley, you have a couple of reports. One on cash out. Why don't you talk about those real quick?
In particular that applies to this is understanding how interest-only loans work. And so I created a report on interest-only loans, kind of the pros, the cons, the risks, the rewards. And I think if folks email interest only at realestateguysradio.com, they can get that report. So interest only at realestateguysradio.com. And then that concept of arbitrage that Russ, you were just talking about, where maybe I set aside some other cash that's invested for positive cash flow to cover any slim cash flow I have on an acquisition I'm hedging inflation and all that with. That concept of arbitrage, if you're interested in learning about how to cash out some equity from another portfolio or a new build you just bought that you want to harvest equity to repeat, there's a report on how to cash out, and that's cash out at realestateguysradio.com.
Yep. And then we have also some information if you're interested in getting in touch with Jackelyn and some of understanding what some of those creative investment loan programs look like. Send an email to CIVIC, C-I-V-I-C, CIVIC at realestateguysradio.com. The point is that whether you engage these folks, some or all of them, or whether you cobble together a team on your own, what you want to do is have a brain trust so that when you're facing these kinds of scenarios, these types of decisions, you get everybody on board who can all talk through. So you want to think about the property type, the geographic market, the property niche, its positioning, the supply and demand dynamic. You want to talk about the team, specifically the property management, get your mind around that. You want to understand your financing options and how you can manipulate them, the cash flow with things like interest only and adjustable rate mortgage options. And then, of course, if you want to put in extra, take a portfolio strategy, either in your own portfolio if it's big enough, or if you want to combine with other investors who are facing similar problems, you can team up to do that through a thing called syndication. If you're interested in that, send an email to syndication, SYNDICATION, syndication at realestateguysradio.com. Love to have you come out to our Secrets of Successful Syndication. Most of the time, one or more of these folks are there, but we have lots and lots of people there that have been playing this game for a long time. We're always happy to share ideas and strategies with you. Thank you, ladies and gentlemen, for being here today and sharing your expertise. Really, really appreciate it. And look forward to doing it again as the world changes, right? As it continues to do.
Yeah.
Yes.
Thanks,
Thank
everybody.
you.
Thank you.
Okay.
Appreciate it.
Thank you, guys.
Take
Bye-bye.
care.
Before you go, three things. Number one, subscribe. When you subscribe, you build up our subscription base, and that helps us reach more people. But even more important, it helps us attract great guests and subject matter experts to share their ideas and information with you. Number two, click that notification bell to make sure that when we do post a new video on this hot topic, you're notified right away. And number three, share. Please share this information with friends. Help them get on board this bus. Help them protect and preserve their wealth to take advantage of what's going on in the world today. All right. Thanks so much, and we'll see you in the next video.